Hey everyone, welcome. It is 1 p.m. on Monday, April 22nd. We just got that closing bell, and there were some very particular levels that we were looking for in the market today. And we got some of them. If we look at how we traded intraday, we said we were looking really at these 494 and the 500 levels right here. And you can see that we made it past that 500 level pretty comfortably. We did pause for a few minutes over here, but then it just went straight up and then we came down. And unfortunately, the bulls did not defend that level, and we did come all the way back down to the VWAP line at the end of the session. So what does that mean? It means that we don't have quite the upward bullish movement or momentum to carry this upward trend into the next few days. So we did get sort of close, it looks like, to that EMA 8. How close did we get? We didn't get that close. Or let's see, EMA 8 today was, oh, it came down. So we were looking at this one yesterday. So it came down. So actually we did get kind of close to that EMA 8. So we may be satisfied that this came and touched the EMA 8. I have a feeling that we're actually going to come closer and actually touch it tomorrow, maybe cross it a little bit, because this should come down a little bit more tomorrow. And then that might be the touch that sends it downwards. So far, I'm not seeing a lot of strength. And you can see that where we closed is just barely above where we opened the previous Friday. And it's certainly under the previous Friday's high. So that's not indicating a lot of strength upwards. If we kind of chop off these wicks up here, then it would basically look like this bar didn't really go anywhere. And certainly if we look up from Thursday, we're still a little bit below Thursday's level, but we're below this purple line, the 500 level. None of this is screaming strength in the market. So while some people might be enthusiastic and be encouraged and say, hey, we got a green day, we're going to bounce. For me, it's like, ooh, yes, yeah, maybe we'll bounce, but I'm not going to get too excited by this bounce. We have that EMA 8 right staring at us, and then we have that EMA 20 and the MA 50 not too far behind. So there's limited room for this market to move upwards, in my opinion. At least if we go by probabilities, there's not that high of a probability that we're going to be able to get above that MA 50. So there's just not that much space right here. So if we move up to the EMA 8 or move up to the EMA 20 or MA 50, basically all we're doing is undoing not even all of the movement from last week, because last week started from the EMA 20 all the way down. So if we can just, even if this week we make it all the way to the MA 50, and all we do is undo last week, and that's not really much progress. That's not something to get excited about. So again, if we get up to these levels, I'm definitely shorting. The EMA 20 is a short opportunity, and the EMA 8, in my opinion, is a short opportunity. And since we have the potential to reach the EMA 8 tomorrow, then we should probably look for some shorts tonight and position ourselves to catch. If there is another bounce up in the market tomorrow, then we might want to position ourselves to capture on a smaller size, because it could go to the EMA 20 or the MA 50. But on a smaller size, we could just set a little trigger right here and say, hey, if we come up and touch that EMA 8, then I want to short some of these weaker stocks in the market. What are those weaker stocks in the market? Well, there's many ways that you can look for weaker stocks in the market. Certainly, you want ones that are underperforming the S&P 500 as a whole. We could look for ones that start to break down, or ones that broke their MA 50 before the S&P broke its MA 50. So they're leading the way down, or in other words, if they're part of the S&P 500, they were part of the weight that dragged the average, which is the S&P 500, down below the S&P 500's average MA 50. So that's one way of doing it. We could also look at stocks breaking their 90-day lows their 90-day or their 52-week lows. We can look, so those would be more like momentum type of stocks. And today, since we had an up day, then anything that made a new low today is actually quite weak versus the market. So we'll take a quick look at all of those. Before we do that, let's take a look at TLT, see what happened there. And it came down a little bit, actually, unfortunately. So it did not continue to move upwards. So it wasn't really helping out the QQQ that much today. Fortunately, it didn't move too much. So let's see what happened in the QQQ. QQQ, 3Q. QQQ, tiny little bounce upwards. This is even less significant than what happened in S&P 500. We've got an engulfing candle. This high is lower than that high. This low is higher than that low. This close is below that open, and this open is above that close. This whole thing is entirely engulfed by this previous candle right here. So that's not indicating a lot. Some people will say, oh, okay, well, it's slowing down. It's slowing down and maybe slowly making this curve. But to me, what that says is there was a lot of drive and momentum downwards, and it wasn't eaten up by the bullish action today. So if I say, what's the energy inside this bar? What's the energy inside this bar? Well, then this one is still dominating. Or if I say I have two of the exact same truck, and these two trucks are the exact same, except this one is going down at 100 miles per hour, and this one is going up at 80 miles per hour, while the one going down at 100 miles per hour wins. So this is not, to me, is not super encouraging. Maybe we'll go up and hit that EMA 8, just like we're anticipating for the S&P 500, but that's kind of the same level of the MA 90 right here, or the EMA 100 right here. And that's just not really encouraging. So, and if we look, let's see, this level would also be almost the minus one ATR. So there's just not anything really encouraging. For one day, we might continue to move up, but after that, the higher probability is that we are going to come down and get our, and it looks like, get our 10% correction. So for me, I'm going to start positioning my portfolio, not positioning my portfolio, anticipate trades that may be able to take advantage of a fuller pullback, further pullback in the to the upside in the market, and then a resumption of the downtrend. So let's take a look at some of those opportunities. Normally, I might be tempted to look at sectors. Actually, I should look at sectors. I may not look at opportunities specifically within the sectors, but I want to see which the sectors are strong, because if the defensive sectors are the ones that are strong and did all of this, that's another sign that it's not that great for the market, because the positioning is defensive. It's not aggressive. It's not for growth. So let's see if that's the case. And then we can look at 90-day highs and lows and that fun stuff. Financial, okay, that's kind of mid-risk, risk, low risk, low risk. So risky stuff are at the very top, but safer stuff right behind it. It's kind of like the mid-risk maybe got shoved down below for some reason. And then we have some choppiness. So discretionary and healthcare down here right next to each other, and communications all down at the bottom. So we do have some fragmentation on the day, so disagreement on the day. That's interesting. Not a super clear picture that we're getting from the sector movement on the day. Let's go stretch out to a week. Definitely defensive on the week. And let's go for 2 weeks. 2 weeks would be before we got bearish. and that was defensive back then too. So overall, I would say that we are looking at more of a defensive lean, but again, today was a little jumbled up. So, and today is the day that we bounced. So this is not going to be too helpful to me. So I'm just going to stick with the plan that we laid out earlier. We can look for stocks that are underperforming the S&P 500 and anticipate that when the S&P 500 bounces back down, then those will be even weaker and bounce down either faster or further. So we'll look at our 90-day highs. We got 49 today, and 90-day lows, we got 27. Not an extreme, and not too surprising that we got a little bit more on the high than the low on an up day. But what we really care about is those lows. Which ones of these are underperforming? So all of these would be on our list as potentials. We have to examine them a little bit further, but we have a little bit of a mix. We've got Tesla and Li Auto, so electric vehicle related stocks, on semiconductor, Roblox, a lot of tech stuff and solar related stuff, alternative energy stuff. Dollar Tree, not doing great. Five Below, so discount stores, not doing great. Public storage, that's usually more of a staple. So we'll keep those in mind. And then let's take a look at how many 52-week highs we have. We got 36. And do we have 52-week lows? That's weird that I wouldn't have 52-week lows right next to it. I guess I might have accidentally deleted it at some time. So we'll just quickly take a look at this is way too complicated. I'm just going to delete all this out and just take a quick look at that. You know what? Let's do it this way. Let's just look at pure price action. So 52-week lows, we've got 133 of them. And then if we do high, $76. So on a long-term basis, we made more lows than we made highs. That's really interesting because on a 90-day basis, we made more highs than lows. What that means is, at least for today, we sort of went in opposite directions. So if we look at this over here, we look at the stocks momentum. And what it's saying is that in the S&P, we didn't look specifically at the S&P 500. We look at the entire market. So actually, we should look. Well, I'll just show you what it means on the S&P 500. It's probably not that big of a difference in the overall picture. So what that's saying is that this 200 days continuing to move down while this MA50 is recovering. And if we look at this chart, it's saying that, okay, why is everything different? Maybe I got logged. Yeah, I got logged out. Okay. So if I look at my area chart over the MAC, then this is still on its way down, which is to be expected. We didn't fall that much yet. And then if I look on the 50-day basis, we see that this looks like it's still coming down, but on a 1-day basis, it kind of recovered a little bit. So not nearly enough to make a difference on this chart, but it has a little blip upwards just for today. I didn't look on previous days, but for today, it's a little blip upwards. And have we fallen enough on this 50-day chart? Maybe it would be kind of aggressive for us to recover straight from here, but it's not impossible. It's not completely out of the range. But as you can see, we have a lot more that we could go down. So on average, it's looking like that when we fall from these heights, we probably come to this 20 to 30 region. And right now, we're only at 42. So any one-day blip isn't going to get me too excited because we could easily just continue to resume downwards into the 20 or 30 region. So where's my stock catcher? There we go. So because of that, since we have this sort of discrepancy here, probably, let's see, 52, I just got rid of those 52 week lows. I'll probably be a little more interested in relative weakness. So 90-day lows for sure are already relatively weak. And now I want to see the relative weakness versus the S&P 500. So let's just take a few of these. I don't know if I can rank order. I should have. Let me think about how I'm going to do this. Okay, we're just going to replicate this. We're just going to copy all this code, which isn't that much. All right, and then we're going to go to our sector scan. Everything in our sector scan is fine. So if we want to see all stocks in the S&P and QQQ that also reached a new 90-day low. Actually, we don't even need this part. We don't need to limit it to SPY and QQQ. So we can just do this. And we have the same list, okay? We should have the same list, just in a different order, because we were sorting that by the average, by how strong they were, relative strength. So I want to sort it by weaker stock. If I look at their chart, then you can see that this one's definitely on a short-term downtrend. It does have some support right here, horizontal support. Tesla for sure is on a mighty downtrend right here. So Tesla could be a good candidate. Iron, gap down, chopping sideways. So we want it to break this range right here before we get too interested in it. DAVA, moving downwards. ATRC, moving downwards. NARI, moving downwards. A lot of healthcare stocks. On semiconductor, Solar Edge, all of these. I mean, they did all make lows, right? They all made 90-day lows. All of these look very, very weak. So the ones that are weaker are the ones that are already below their previous low over here, their 6-month low. So, for example, this one, ZTS, below the 6-month low over here. Same with INTA, below its 6-month low. This one is not quite there. That's the 6-month low right here. So we're not quite there yet. So there's a lot of candidates here. So what we would want to do is look at their options, see how liquid they are, how much volume, how much open interest, what the bid-ask spread is, and then what the reward risk ratios are for the various deltas that we might choose. So that's obviously going to take a while. That's not something I'm going to do in front of you guys because you'll be staring at me doing some kind of boring stuff to watch for a while. So we'll just leave that as is and just say, hey, this is how these are candidates. These are all good candidates. The better candidates are the ones that have already, like today is not only the 90-day low, but it's also the 6-month low. 90-day low would be roughly about 4 months because of the roughly 20 trading days per month, 22 trading days per month. So a 6-month would be, we would be looking at about 122 or 120, I guess, times 6. So 132 days low versus just the 90-day low. So if it today is both the 6-month low and 90-day low, then that's more powerful than if it's just the 90-day low. So I would take a look at all of those as potential candidates for shorting. And then what you could do is wait for a little bounce. So if I'm expecting the S&P to bounce up to the EMA 8, and then I look at Tesla and say, well, if the S&P bounces to the EMA 8, would the Tesla go all the way to the EMA 8? This looks a little bit weaker than the S&P. So my answer would be maybe not all the way, but could we get to maybe this previous day close? Probably pretty easily. Maybe the previous day open even, maybe even the previous day high. So that's not quite at the EMA 8, but I could set a price target right there. If it hits anywhere in here, then I'm willing to purchase a put on that Tesla. And if it doesn't and just goes straight down, then oh well. Tesla I wouldn't do. It has earnings in a couple days, so we're going to be paying a lot in implied volatility on the options. So generally, if you're just even if you're just going to hold on to it for a short period of time, well, then you probably want to avoid earnings within the next 2 weeks, unless your plan is just 2 or 3 day holds. So for example, Tesla is reporting on Tuesday, tomorrow. Never mind, you wouldn't do Tesla at all. You would wait for those earnings to come out. But let's just say Tesla was reporting in 5 days. I'd say, okay, well, I'm going to buy it tomorrow. That gives me 4 days left before earnings. And so I'm going to for sure sell it within 3 days, because when I sell it in 3 days, that volatility is still really high. It hasn't come down yet. So even though I'm paying a lot of money for volatility, when I sell, I'm selling that same volatility or a similar volatility. So volatility doesn't hurt me that much. I can focus on the price action. If I cross or get on that earnings date, then I could get burned. So you have to be very careful about trading around earnings dates, especially options. It's important when you're looking at equities, but when you're looking at options, it's super critical. Okay, so maybe let's just take a quick look and see if there's a candidate that we like that doesn't have earnings. DAVA, Nari. Okay, I like Nari. So we could say that's 2 weeks away. That is 1 week away. Okay, so I'd probably avoid Nari also, except for unless it's going to be one. You know what? I could do this for a 1 day trade or a 2 day trade. If I say, hey, if the S&P 500 goes up to EMA 8, does Nari come up and hit the EMA 8 as well? And the answer is maybe. But if I want to be a little bit more conservative, maybe we'll get in. I would just set my entry at the highs of these previous 2 days. And what is a good target? Well, look how low it's able to reach today. Well, is this move in a single day from up here all the way down here? Is that a good move? Is that a good trade? I would say, yeah, that's a pretty good trade if you selected your options very carefully. So that could be a nice 1 or 2 day trade, and then you can get yourself out of that trade, even though we're reasonably close to earnings. We're not so close to where you wouldn't be able to sell a similar volatility as what you bought. Okay. All right, that's what we're looking at. I can't really think of anything else. Actually, maybe just real quick to see if this Fed Watch tool is running now, or at least if my computer can load it now. There we go. So the May 1st May date, basically almost 0 chance, the 3.7 chance of that cut. And if we look at our June, still back down, but probably floating around in the 16-17% region. Just call it 15 to 20% region. If it just splits around there until we get closer to June, then that wouldn't be surprising to me. Unless we get some wild data this week out of the PMI and the PCE reports. Okay, so let's just watch. Let's see if tomorrow we can trade up or cross the EMA 8. And then most likely we'll anticipate that it comes down. And especially since we weren't even able to overcome this 500 level today or stay above the 500 level today. So the pressure downward is higher, and we are still at this point expecting that larger correction. We're just trying to position ourselves or time ourselves a little bit better rather than just saying, hey, let's just go in a short right now. If I was doing a 2, 3, 4 week trade with expirations of at least 50 days, then yes, I could do that. I wouldn't care about a little bit of fluctuation upwards. But if I'm doing a 1 or 2 or 3 day trade, a 1 week trade, I'm going to care a lot more about that precise execution. So we'll just see if we come closer to that EMA 8. Remember that tomorrow, depending where we open, that EMA 8 is most likely going to be quite a bit further down. And it's going to be easier for us to touch that EMA 8 and then bounce down off of it. So that's it for today. We know exactly what we're looking for tomorrow, and we'll be prepared in the morning. We'll see how close we get to it. We'll look at important levels. If there are any other new important levels other than the ones we've already drawn on here, and then we'll take it from there for the trading day. All right. Have a wonderful evening, and I will see you tomorrow morning.